Moving on, something else I wanted to bring to everybody's attention. So the rest of the market today, we're seeing massive bullish fundamentals across the board. I mean, in Ripple, we're seeing phenomenal bullish fundamentals. We saw freaking Brad Garlinghouse take a picture with President Trump, and all the Riddlers are freaking out because there were bullish candles behind them, right? I mean, it's literally nuts. We had Cointelegraph announce that China plans to integrate blockchain into its national data infrastructure. Interestingly enough, was it Red Day Technology, if I'm not mistaken, um, that partnered with Flare off the top of my head that helps China's data infrastructure, or not data infrastructure. I'm having a brain fart off the top of my head. Identity infrastructure. Is it Red Date that I'm thinking of?
Yes, red date ID.
Right, Red Day ID, and they partnered with Flare for a proof of concept to, build a blockchain infrastructure for China's national data or data identification or something like that. I just think that that's interesting that they're now announcing that after they tested this whole entire concept on Flare. So again, what I'm just trying to present here to you guys is that you will see these types of things. Cointelegraph, CoinDesk post all these bullish fundamentals. We have to understand that these assets as a whole in the broader market landscape are not being utilized for their utility yet. Okay. So when you see these things, don't be the confused retail investor that's like, well, what the heck? Why is my portfolio not performing well? Understand the fundamental drivers that the larger asset managers and financial institutions are paying attention to. And that boils down to central bank positioning, monetary policy, intraday fundamentals in terms of PPI, CPI, inflationary reports, labor market data, all of those things, right? Geopolitical tensions and escalations, political uncertainty surrounding presidential campaign participants, so on and so forth. All of these things that weigh on sentiment or risk assets, understanding that crypto, one within itself, is inherently the riskiest asset class on the face of this planet. So when there is an intraday demand for safe haven assets like gold, bonds, or the United States dollar or Japanese yen, there tends to be an excessive outflow of risk assets regardless of these fundamentals. So look at these fundamentals as long-term bullish for the space because they are. I'm not knocking that by any means. You guys know that I am a bull in this market long term, but understand that short-term price fluctuations still remain number one priority to build proper portfolios in this space in the short term. And if you try to base your entries in this market off of these little, I, I don't want to call them little, but these types of fundamentals, you're not going to win in terms of seeing price appreciation in the short term because these things most likely won't affect the market until later on down the road when we see more regulatory clarity, more institutional inflows, and so on and so forth. Okay. So just keep that in mind. I wanted to bring that to everybody's attention because I couldn't imagine being a retail trader that sees something like this, right? Just in. This was posted today, January 8th, 2025. RLUSD stablecoin to list more exchanges imminently, says Ripple's president Monica Long, who also said that she expects an XRP spot ETF approval very soon. That is an extremely bullish comment. And albeit XRP is a top performer, up 2.77% today, it's still pulled back with the entire broad market landscape today. So it is not, you know, excluded from the entire market volatility when we see a risk off market mood. Okay. So here at CyPRX, we try to clarify all these things and cut through all that noise and really pick apart the things that have weighed on market sentiment. So let's talk about those things real fast before we jump into the FOMC meeting in minutes. Crypto market suffers $250 billion wipeout amid strengthening dollar, political uncertainty, and mounting geopolitical tensions. Over the past, give me a second, let me mute you guys. My goal, by the way, towards the end of this report is for everybody to understand why there was a risk off market sentiment. And then we're going to go over some of the scenarios that we would need to see later on throughout the entirety of the week as we finish and head into the weekend to see a risk on market mood come back into fruition. Over the past 48 hours, the crypto market has tumbled by more than 250 billion, driven by a confluence of factors that have sparked a wave of risk off sentiment. Excuse me. From surprisingly strong US economic data to political and geopolitical uncertainty, traders and investors are flocking to safe haven assets such as the US dollar and gold. Below, I've written a detailed breakdown of the key drivers behind the sell-off and why each of these scenarios is weighing on risk assets like crypto. Before I read through this, does anybody want to openly discuss and talk about just a simple sentence, why we're seeing a risk-off market mood today? Give me one factor.
A pause on interest rates.
Okay, Avidwa, good job. A pushback on interest rate cuts, right? Anybody else? That's good. That's one.
Unemployment, labor cool.
Unemployment claims, yeah, absolutely. The labor market data that we got this week came out relatively upbeat, came out strong, came out showing signs of resilience, also pushing back on Fed rate cuts. Good job. I think it sounded like either Angel or who was that? Alex, who was that?
Me,
Yeah. Good job. All right. So we have upbeat labor market data showing signs of strength and resilience, right? And that has pushed back on rate cut expectations. Overall, the market sentiment has dialed back rate cut expectations. Remember in previous reports, which we'll get into in today's video breakdown, I talked about that. I specifically mentioned in previous Zoom calls, which I incorporated in this fundamental breakdown. We mentioned that if that percentage chance of a Fed rate cut starts to decrease, meaning that the probability lessens that the Fed's going to cut rates in 2025, that's most likely going to create a risk-off market environment as market participants start to dial back the expectation of future rate cuts from the Federal Reserve, right? Anything else? So we have, generally speaking, economic data pushing back on rate cuts, and we just have the general idea of markets pricing in less probability or chance of rate cuts in the near term. What else do we have? Two other factors I'm looking for.
Global economic tensions within
Okay.
the Middle East and the Russia-Ukraine war.
Good job, right? Geopolitical instability. Let's just chuck it off to that. We still have rising tensions in the Middle East, breaking headlines in Russia, Ukraine. Those mother truckers just never calm down. They're always killing each other, breaking headlines, people being fearful on a global scale that those tensions are going to continue to escalate. And what that does, from a large institutional perspective, is that shows them that the geopolitical landscape is still unstable, and that creates more of a demand for safe haven and less of a demand for risk assets. So very good, D'Angelo. So geopolitical instability, pushback on rate cuts. What's the last one? More recently, has to do with President Trump.
tariffs.
The tariffs.
Tariffs, right? Tariff fear, uncertainty, and doubt. Monday was crazy because Monday, I don't remember what it was. I think it was the Wall Street Journal put out some report that said that President Trump's tariffs weren't going to have as negative of an effect on the markets as markets had previously anticipated. And on Monday, we saw a risk on market sentiment. Everybody was like, oh shit, tariffs aren't going to be that bad. Inflation's not going to skyrocket. It's all good, right? And then later on in the Asia session, Trump came out on Truth Media and was like, yo, Wall Street Journal is a liar and they don't know what the heck they're talking about. And my tariffs are going to fuck up the economy and trade policies and all this stuff and probably escalate or lead to escalating inflation. And then the market was like, oh, okay, shit. Well, Wall Street Journal's messed up or wrong. And so now these tariff uncertainties are back on the table, right? Very simplistic. The market does not like uncertainty. And so when President Trump came out and said that, that brought uncertainty back onto the table of further fears of escalating inflations, uncertainty surrounding trade wars, all of that stuff, and that deteriorates risk appetite. So good job. I don't know who said that, but good job. Okay. So in a nutshell, I don't know if you guys want me to continue to read through this because that's exactly what this report talks about in detail. But it goes over those things. Strong labor market figures, right? November job openings, we had surged to a high of 8.098, beating the market forecasts. Anytime the economic data, especially from the United States, comes out above the market forecast or above previous readings, that tends to push back or deteriorate rate cut expectations. Okay. And especially in the labor market figures, that is what happened. Okay. I said here, this unexpected strength affirms that employers are still hiring, reinforcing optimism about the labor market strength. We also had robust ISM non-manufacturing PMI figures, rose from 52.1 in November to 54.1 in December. Remember, anything in terms of PMI figures that comes out above the 50 grade mark or above previous readings shows signs of economic expansion or economic resilience and strength. Economic resilience and strength tends to deteriorate rate cut hopes. So I said here, this expansion implies strong consumer demand and economic momentum, making it less likely that the Federal Reserve will aggressively cut interest rates moving forward in 2025. As of right now, that could change. And it could change if we started to see deteriorating PMI figures, things showing signs of contractionary ranges or figures, anything coming out below previous market expectations, previous readings, or below that 50 grade mark, right? So the impact that these economic indicators have on risk assets. A stronger dollar, safe haven demand, tends to reduce the relative attractiveness of cryptocurrencies, which are typically viewed as a high risk, high reward instrument. As the greenback or the dollar rallies, investors often rebalance their portfolios into more traditional safe haven plays, which puts pressure on crypto prices. And then I just talk about why this matters and so on and so forth. Okay. Political uncertainty clouding the US economic outlook. So political developments in Washington have introduced another layer of complexity. This is the President Trump tariff situation. President-elect Donald Trump's evolving stance on tariffs, ranging from sector-specific levies to the potential national economic emergency, to inducing a potential national economic emergency, has kept global markets on edge, creating turbulence that spills over into crypto. So I won't beat a dead horse. In a nutshell, this creates a whole bunch of uncertainty, not only surrounding the economy, trade wars with other multiple jurisdictions, and fear of possible elevated inflationary pressures after Trump enacts these tariffs. Okay, so in a nutshell, what does that do? That pushes back on rate cut hopes, that elevates market uncertainty, and that creates more of a demand temporarily because it could change depending on future market conditions, but temporarily that weighs on risk appetite. You can see here a snippet from January 8th, 2025. S&P futures slip on Trump tariff worries. The S&P is a risk asset class, right? Futures, they're a risk asset class in cooperation with cryptocurrencies. Pretty much in a nutshell, I write and talk about the same exact thing. Previously, the markets were extremely optimistic. I remember at the end of last week, we were talking about this. We mentioned that it doesn't seem like the market is starting to price in anymore, that these tariffs are going to have a negative implication. And then on Sunday, Monday, we saw that, I guess you could call it a fake report from the Wall Street Journal, I think it was, talk about how tariffs weren't going to have a drastic negative effect on markets. And then Trump pretty much came out and dialed back that whole entire optimistic perspective and said, yes, they are. He called it fake news, and he dismissed that these reports were going to have any type of positive implication on the markets, right? So that just brought more market uncertainty. I incorporated that whole entire report that I wrote to gather that information from CNN. I highly suggest you guys read through it so that way you understand the sentiment and the conditions moving forward. Number 3, somebody had mentioned, I think it was D'Angelo, he talked about escalating geopolitical tensions in Ukraine and Israel. Very simplistic. We saw breaking headlines surrounding Russia, Ukraine. Here that is from January 7th. That is when the turmoil started yesterday. Russia claiming capture of Ukraine's Kirkov. I'm going to butcher that one, so excuse me. But again, just the battle raging and breaking headlines surrounding geopolitical instability. Not only that, but we also had a breaking headline stating that Israel military standing on high alert as regional tensions and Iranian rhetoric continue to escalate. So those two things, coupled with the fear of tariffs and coupled with the elevated economic data from the United States, creating more of a demand for the United States dollar and pushing back on rate cuts, were all more things that contributed to the risk-off sentiment. Keep in mind that when there's geopolitical instability on the global scale, the United States dollar doesn't only rise or increase because of a pushback on rate cuts or the growth of the strength of the United States economy, it also holds global reserve currency status. So whenever there's fear, uncertainty, and doubt in other major jurisdictions, people tend to flock to the United States dollar as a safe haven. Okay. So it's not only rising or increasing off of economic strength in the United States, but also due to its global reserve currency status as a safe haven. Okay. The impact that this has on risk assets, very simplistic, is that when global hotspots flare up, investors generally rotate out of volatile assets like crypto and turn to safety in the United States dollar, government bonds, or gold. All right. And then last but not least, we had the decrease in the likelihood of the Federal Reserve rate cuts narrow themselves back. In this report, as I mentioned on January 6th, at roughly about 15 minutes and 12 seconds in the Zoom call, is when we discussed and we talked about this. And I specifically mentioned that what we would like to see a risk on market mood, is we would like to see the probability of a rate cut increase above 50% at the March meeting. And if you remember in previous reports as well, the probability of a January rate cut was at 11% chance of a 25 basis point cut in January. Now that chance has dwindled in January down to 4.8%. And the probability of a 25 basis point cut in March has dropped below 50%, which in previous weeks, the probability of the Fed cutting rates in March was above 50%, and the probability of them cutting rates in January was above 10%. And so those percentage chances decreasing has led to the market starting to price in a higher for longer interest rate environment currently. And as I mentioned in this report, that would deteriorate risk sentiment. Okay. So those are the factors right now. I think that's four primaries that I could see weighing on risk sentiment. Four primaries as to why the market looks like this today and why these bullish fundamentals here that I just showed you guys and these freaking riddlers that I cannot stand, man, holy crap, is stuff that if you're going to pay attention to this, it's great to read, to have an optimistic perspective long term so that you're aware of the market conditions and how things are going to unfold. They are building out a new infrastructure. Yes, these digital assets are most likely going to be incorporated into the new financial system and all that stuff. But I could not imagine, again, being a retail investor that bought on Monday and has seen blood in my portfolio, not understanding why, and just being completely demolished mentally after probably watching some type of bullish moon boy video on Monday where everybody was thinking that crypto was going to go to new all-time highs. Okay. Again, in this community, we had a Zoom call. Here's that Zoom call right here. I believe this was also from January 6th, where we projected this pullback. We don't do anything extensive or unrealistic. I simply said to you guys that if we see a risk off market mood and we fail to break the most recent December 2024 high, that the most likely scenario was that we were going to pull back into the December lows. You guys can see that I drew on the charts. This was roughly at about 24 minutes and 16 seconds into this previous Zoom call. The two risk off scenarios that I mentioned, extremely upbeat data, sparking fears of an overheating economy that again would trickle into leading the markets to start to price in a higher for longer interest rate environment, a pushback on rate cuts, or in a worst case scenario, this would be extremely bad if the market started to price in the possibility of a Fed rate hike, right? Which I don't think is going to happen, but if it did, and we did not break above these previous intraday highs, most likely scenario is the market is building liquidity underneath of these lows in the form of over leveraged positions. And we are most likely to some degree going to come and attack those lows and see a further market retracement of this previous bullish move from the previous optimistic NFP report back in November. And now looking at where price action is at, how accurate that analysis is. Nothing over drastic, nothing over like, no, we didn't use any Fibonacci extensions or magic indicators. This is literally just logic. Okay. If there's a risk off market mood, we're going to see an increased appetite intraday for gold, silver, bonds, and the dollar, or even possibly the Japanese yen, depending on market conditions. And we're going to see profit taking on risk assets like stocks and crypto. It's very simplistic. Okay. These days should be seen as opportunity, in my personal opinion, to get a better dollar cost average position across your long-term portfolio. All right. So With that being said, moving forward, let's look into the near-term future. What would we ideally like to see a sustainable risk-on market mood come back to the markets? Here are a couple fundamental drivers that we would like to see. This would be a picture-perfect scenario. Okay, keep in mind that we might not get all of these things, but if we can start to see a couple of these things sprinkled in, returning market investment or returning market optimism back to the table, then we could start to see price appreciation come back to the forefront, where this market pullback just turns into exactly that, a slight market pullback to re-enter into to discounted positions that we saw back in December, and then elevated prices as we head into the weekend. All right. That would be if we get, I laid them out for you guys. The Fed clarifying its rate outlook and indicating any possible shift towards a more accommodative monetary policy stance. I believe we still have some Fed speakers on the table the remainder of this week, tomorrow and Friday. So ideally, we would like to see them come out supporting future rate cuts or delivering any type of sentiment that brings back rate cut hopes to the table. We would also like to see no further geopolitical tensions or escalations or any breaking headlines surrounding Russia, Ukraine, Taiwan, China, the Middle East, anything that sparks fear, uncertainty, and doubt. And we would like to see headlines that talk about de-escalation and geopolitical tensions or ceasefire talks or agreements that there aren't going to be any more casualties, whatever the case may be. As long as we see those things, that could be a sentiment driver to bring back risk appetite to the table. We would like to see political clarity on the scope of President-elect Trump's potential tariff actions. I don't think that we're going to get that until after his inauguration. So don't quote me on that, but it would be phenomenal to see if he came out and he was like, yeah, my tariffs aren't going to lead to escalating inflation. That would definitely boost risk sentiment because, again, that is one of the key things dampening risk sentiment right now. And if he eased that uncertainty, if he informed market participants that that wasn't a concern, that would bring back more risk appetite. Okay. And then last but not least, our primary focus is US labor market data this week in the form of unemployment rates and NFP figures that support future Fed rate cuts, which we broke down in detail in a previous video breakdown. So make sure that you guys go back and you watch that. We'll get into that in just 1 second when we read the FOMC meeting in minutes. All right. So if we can get any of these factors, or best case scenario, all of these factors in the market before we head into the weekend, then most likely what we would see is a bounce from the most recent intraday lows, or a possible even slight drop or decline down into more discounted prices from back towards the end of November, liquidating December lows, and see a bounce from roughly around 2.9 to possibly $3 trillion. You guys can see that over the past couple of trading sessions, the $3 trillion to $3.1 trillion mark has played a very significant role in holding price action above that level. I would say that if we start to deteriorate further below the most recent December lows, that would be a sign of concern. If we can hold above these most recent December lows, or roughly again about 3.1 to $3 trillion, and we can see any of these fundamental factors bring back stability to the markets and optimism into risk assets, then we have nothing to worry about. Okay. Inversely, the scenarios that we need to be further worried about is if we see any of the Fed speakers the remainder of this week or over the weekend, because we did have some Fed speakers over this past weekend, so be cognizant of that. Any Fed speaker signaling a more hawkish policy stance, right? Pushing back further on rate cut hopes, stating that inflation remains elevated, economic strength in the labor market and overall economic data is deteriorating the hopes or the expectations of future rate cuts, so on and so forth. Anything that pushes back on rate cut optimism. And that could also be on a global central bank spectrum. Okay. I know that we're not covering right now the ECB or the Bank of England or the Bank of Japan, but just be mindful of their central bank positioning as well does affect market sentiment, right? We're not talking about it in this report, but any fear, uncertainty, and doubt surrounding the Bank of Japan rate hike in January, or them possibly hiking rates in January or near term, could definitely create further fear, uncertainty, and doubt in the market. I did not write about this in that report here, but we have talked about it in previous video breakdowns, so just be mindful of that. Any new conflicts that arise or existing conflicts deepen, right? So any new breaking headlines surrounding any war outbreaks, new jurisdictions getting involved, casualties, bombs going off, any of that stuff that sparks fear, uncertainty, and doubt, that could also deteriorate market sentiment further. And then any political uncertainty surrounding President Trump's tariffs. It seems like right now, the two factors that are weighing on market sentiment the most are the President Trump tariffs and the Fed's hawkish commentary. So just be mindful of that. If those things start to intensify further, that's definitely going to lead to a more risk off market approach, and we're probably going to see a deeper market retracement. Okay. And then Friday, any stronger than expected labor market data that delays or leads to the markets expecting further delays in rate cuts. I think that that's going to be our primary for right now, because we do have that data set to come out over the next 48 hours. And if it comes out showing signs of strength and resiliency in the labor market, i.e., the data showing that the labor market is extremely strong and robust, surpassing market forecast, and even worst case scenario, surpassing previous readings, that is going to deteriorate the optimism surrounding rate cuts significantly. And we're probably going to see a sharp decline in risk assets as we head into the weekend. So just be mindful of that. Like I said, we'll get into the inverse scenario here in just 1 second. So you guys have these factors. Make sure that you understand them. Very simplistic, nothing extravagant. If we see a deteriorating risk sentiment or market mood, I'm expecting a break below $3 trillion to possibly 2.9. And we're most likely going to start to make our way and correct the November move, possibly sending us down towards the mid-November higher lows at about 2.9 to 2.8 trillion, or possibly correcting the move further. That would bring us down to 2.2 to 2.5 trillion dollars. All right. I don't think that the market is going to fully recover from this downbeat market move. If it did, I would be surprised. I personally only expect ranging price action up until President Trump's inauguration. The reason why I say that is because there's a lot of uncertainty surrounding what's going to happen once President Trump comes into office. For example, another retail fundamental thing that's like driving a lot of investor optimism is Gary Gensler resigning on the day that Trump is inaugurated. Well, what if the day that President Trump is inaugurated, Gary Gensler comes down and says, you know what? I'm not stepping down. Right? So I'm not saying that that's going to happen, but there's still so many uncertain factors at play that could unfold before Trump's inauguration that will most likely clear themselves out after Trump's inauguration. So I personally don't think that we're going to see any extremely upbeat price action until after President Trump's inauguration and until we get more economic data later this month. So right now, I still think that we're going to stay suppressed below the most recent December 2024 highs in the total cryptocurrency market cap. We could see a bounce back from this most recent depreciation in price, but I don't think we're going to supersede the December 2024 highs. If we do return or revisit those highs, then I'll reanalyze price action at that point in time. But right now, I think that we'll probably just range sideways, remaining above the $3 to $2.9 trillion mark, possibly even revisiting the most recent high, but nothing superseding it. Unless we see a Goldilocks scenario, like I just mentioned, where all of these things paint a crystal blue picture and we're like, oh shit, okay, things are extremely optimistic. There's still too much uncertainty right now. Long term, though, I'm still bullish. I hope you guys understand that. Even if we did see a market pullback down into November lows, or maybe even worst case scenario, the Bank of Japan hiked rates or some crazy shit, and we saw a drop all the way down to like 2 trillion or 1.5 trillion dollars, I would still look at that as a market opportunity to take discounted positions. Okay. So for any of you new people on CYPRX that haven't heard that before, you've heard it now. Any market pessimism, in my personal opinion, should be seen as an opportunity because we all know where this market's headed long term. Okay. It's more so about dealing with these price fluctuations mentally in the short term and understanding when to be a market participant and when not to. When you see this shit on the internet, everybody on the internet's extremely optimistic, but the market looks like this. These are days you should be buying, right? When this whole entire crypto bubble thing looks green, right? Those are days you should be sidelined, saving cash positions, earning yield on stable coins to grow cash. So that way, when the market looks like this, you can go in and redeploy and build bigger bags. Okay. So I want to read today the FOMC meeting in minutes for you guys, and then just break down the perspective that they delivered to the market and kind of go over from the Fed's perspective what they want to see in terms of economic data to bring rate cuts back to the table. The reason why I want to read that is because as retail analysts, we can see kind of into the future as to what data we would need to see that would support a risk on market mood, right? By deciphering their comments and paying attention to future data releases and understanding how that data would need to come out to support a risk on market mood, we can gauge price action in the future of market volatility. Okay. Now, obviously, of course, we cannot gauge black swan events. We cannot gauge when these headwinds are going to happen or anything like that. But as we've shown in multiple video breakdowns before, and if you've been in this community for a while, how accurate it is to do this stuff, it's not hard to predict these markets if you have a logical perspective and you understand these fundamentals. All right.